The ongoing evolution of U.S. China trade dynamics signals dire consequences for American farmers, particularly those in the soybean sector. Former President Donald Trump's first trade war with China had already inflicted an $11 billion blow to U.S. soybean farmers. With Trump now vowing tariffs once again as part of his renewed campaign rhetoric, the stage is set for another challenging chapter. However, this time, China's shift toward Brazil as a primary supplier of soybeans exacerbates the situation, leaving U.S. farmers in a precarious position. The legacy of the first trade war. The trade war that began in 2018 was a transformative period for U.S. agriculture. American farmers, particularly soybean producers, became collateral damage in a broader geopolitical battle. Trump's imposition of tariffs on Chinese goods prompted swift retaliatory measures from Beijing, including a steep 25% tariff on U.S. soybeans. As a result, American soybean exports to China, which had peaked at $14 billion in 2017, plummeted by 79% in the first 2 years of the Trump administration. For U.S. farmers, China had been the largest export market, purchasing approximately 60% of the nation's soybean output annually before the trade war. Losing this market forced American producers to scramble for alternative buyers, with mixed success. While countries like Mexico and the European Union increased their imports slightly, they could not replace the scale of China's demand. China's strategic pivot to Brazil. China's reliance on U.S. soybeans was historically rooted in its need for high-quality supplies to feed its massive livestock industry. However, the trade war accelerated a strategic pivot toward Brazil, which had long been a significant competitor to the U.S. in the soybean market. Brazil's geographic proximity to China, coupled with its ability to produce soybeans at a lower cost, made it an attractive alternative. During the trade war, China poured resources into deepening its trade relationship with Brazil. Brazilian soybean exports to China surged, and infrastructure improvements in ports and railways facilitated even greater efficiency in moving goods to Asia. By 2023, Brazil accounted for approximately 70% of China's soybean imports, solidifying its dominance in the market. China's diversification strategy also included investment in domestic soybean production and purchases from other nations like Argentina. This shift meant that even as U.S. China trade tensions cooled under the Biden administration, China's reliance on American soybeans remained minimal. The impact on U.S. farmers. The loss of the Chinese market has had ripple effects throughout the U.S. agricultural sector. Soybean prices, a critical determinant of farmers' incomes, were already volatile due to global economic uncertainties and climate change. The additional loss of demand from China exacerbated this instability. For smaller and mid-sized farms, which lack the financial cushion of larger agribusinesses, the trade war's impact was devastating. Many struggled to stay afloat, taking on significant debt to cover operational costs. Government subsidies, including the $28 billion bailout during Trump's tenure, provided temporary relief, but were insufficient to address the long-term challenges posed by market loss and increased competition. Even for farmers who diversified their crops or shifted to alternative markets, the transition was fraught with challenges. Soybeans require specific soil conditions and farming techniques, making it difficult to pivot to other commodities without incurring substantial costs. The challenges of regaining market share. Restoring the U.S.'s stature as a leading crop exporter faces significant hurdles. First, rebuilding trust and relationships with Chinese buyers will be a complex and time-consuming process. The trade war highlighted the risks of over-reliance on the U.S. as a supplier, prompting China to prioritize supply chain diversification. Second, Brazil's dominance in the market poses a formidable challenge. The country has not only expanded its production capacity, but also positioned itself as a reliable and cost-effective supplier. With China investing heavily in Brazilian agriculture, the U.S. faces an uphill battle to reclaim its lost market share. Additionally, geopolitical tensions between the U.S. and China have shown little sign of abating. Trump's campaign promises to impose tariffs if re-elected signal a potential return to adversarial trade policies. Even if U.S. farmers can offer competitive prices, the broader political climate may deter Chinese buyers from re-engaging with American suppliers. Broader implications for U.S. agriculture. The soybean saga underscores the broader vulnerabilities of U.S. agriculture in a globalized economy. Overdependence on a single market, as exemplified by China's dominance in the soybean trade, leaves farmers exposed to geopolitical shifts and policy changes. Diversification of export markets is essential, but it requires significant investment in infrastructure, marketing, and trade negotiations. Moreover, the trade war highlighted the interconnectedness of global supply chains. Disruptions in one sector can have cascading effects, as seen with the increased costs of feed for livestock and the subsequent impact on meat prices. For consumers, these dynamics translate into higher grocery bills and reduced food security. Navigating the path forward. To mitigate the impact of the trade war's sequel, U.S. policymakers and agricultural stakeholders must adopt a multifaceted approach. 1. Strengthening domestic markets. Encouraging domestic consumption of soybeans through biofuel production and other initiatives can reduce reliance on exports. Expanding markets for soybean-based products, such as plant-based proteins, may also offer growth opportunities. 2. Diversifying export markets. Building trade relationships with emerging economies in Southeast Asia, Africa, and the Middle East can help offset the loss of Chinese demand. These regions represent growing markets for agricultural commodities and offer opportunities for U.S. exporters to establish a foothold.